As the U.S. markets are closed for the weekend, SoFi Technologies, ticker SOFI, finished its last trading session on Friday, November 7th, 2025, at a closing price of $28.21. This was a very strong end to the week, with the stock climbing $1.07, or nearly 3.94%, on exceptionally heavy volume of almost 79 million shares. That move, however, only tells a fraction of the story. The expectation for a stock that just delivered a record-smashing quarter would be a smooth upward climb. But the reality for SoFi investors has been a brutal lesson in market mechanics, as the stock is still trying to recover from a sharp double-digit percentage drop that happened after it reported those fantastic earnings. This is the central puzzle facing SoFi traders right now. The company is executing flawlessly, but the stock is behaving erratically, caught in a tug-of-war between fundamental bulls and technical traders taking profits. Let's first establish the common ground, the narrative that everyone, from Reddit forums to cable news, seems to agree on. The belief is that SoFi is the future. It's the all-in-one digital bank, the one-stop shop that will capture the younger generation and, through its financial services productivity loop, cross-sell them everything from a checking account to a mortgage, all while powering other fintechs through its Galileo technology platform. The company's recent third-quarter report, which dropped on October 28th, seemed to confirm this belief in every conceivable way. The numbers were not just good, they were a blowout. SoFi posted record-adjusted net revenue of $962 million, a 38% jump year-over-year. It delivered its 8th consecutive quarter of GAAP profitability, with net income hitting a record of $139 million. Earnings per share came in at 11 cents, crushing the 8-cent estimate. And most importantly for the long-term thesis, it added a record 905,000 new members, bringing its total to 12.6 million. Its technology platform and financial services segments, the high-margin, non-lending parts of the business, now account for 56% of total revenue. By every metric, SoFi hit a grand slam. The expectation, naturally, was for the stock to soar. The reality was the exact opposite. In the days following that blockbuster report, the stock fell and fell hard, shedding roughly 14%. This is what has so many retail investors confused and frustrated. Why would a stock plummet on its best-ever report? The answer is a classic case of sell the news. The stock had already run up significantly into the earnings announcement, and institutional players, seeing the perfect print, used the high volume and retail excitement as liquidity to sell their positions and lock in profits. This doesn't mean their long-term thesis is broken, but it shows the difference in strategy. Retail investors are holding for the 10-year growth story. Large funds are trading the 10-day volatility. This past week's action confirms this battle. The stock plunged 9.68% on Thursday, November 6th, on massive volume, only to rip higher by 3.94% on Friday. This is not the chart of a stable, predictable company. It's the chart of a battleground stock. Because it's such a battleground, we have to look at the short interest. There is a significant and vocal bears betting against SoFi. What's your take on the 8.5% short interest? Is it smart money betting on a pullback, or just a hedge against volatility? Let's look at the data. As of the most recent filings, SoFi has just over 100 million shares sold short, which accounts for about 8.47% of the free float. Now, 8.5% is not a mean stock squeeze number, but it is a very significant figure. It shows that for every 10 bulls, there is nearly one major bear willing to put substantial capital on the line, betting the price will go down. The bull case is that these 100 million shares represent future forced buyers. The bear case is that they see something the bulls are ignoring, likely related to valuation or the microenvironment. But here is where investors need to be smart and look deeper. Just seeing a high short interest number isn't enough. You must look at the cost to borrow those shares. Right now, the borrow fee rate for SoFi is incredibly low, at around 0.41%. This is a critical piece of information. It means that it is very cheap and very easy for institutions to short the stock. There is no panic, and brokers are not running out of shares to lend. This is not the setup for a high-pressure squeeze. A low borrow rate suggests these are structural, thesis-driven short positions, not a frantic, crowded trade. Furthermore, the days to cover is also very low, at just 1.53 days. This metric tells you how many days it would take for all the short sellers to buy back their shares based on the average daily trading volume. At 1.5 days, they could cover their positions very quickly without causing a massive price spike. So, while the short interest is high, the data does not point to an imminent explosive short squeeze. For investors who want to track this, you can find this information on financial data platforms or with a delay on the NASDAQ website itself. You are looking for short interest as a percentage of the float, the cost to borrow rate, and the days to cover. A sign of a developing squeeze would be the cost to borrow rate spiking from 0.4% to 10, 50, or even 100%. That would signal that shares are becoming scarce and short sellers are getting desperate. We are not seeing that right now. We are, however, seeing a high level of off-exchange short volume, with 30 to 40% of shorting activity happening in dark pools. This suggests institutions are an active part of the short thesis, not just retail traders. To understand why someone would bet against a company with such stellar growth, you have to understand its business. SoFi is not just one company, it's three distinct businesses in one. First, you have the lending arm. This is the original business: student loan refinancing, personal loans, and home loans. SoFi makes its income here from the net interest margin, which is the spread between the interest it earns on these loans and the interest it pays out on its deposits. Thanks to its national bank charter, it can fund these loans with low-cost deposits from its checking and savings accounts, which dramatically widens its profit margin. It also sells bundles of these loans, a process called securitization, for upfront cash. This segment is very sensitive to the broader interest rate environment. If rates get too high, demand for loans can slow down. Second is the financial services segment. This is the one-stop shop you hear about. It includes SoFi Invest for stock and crypto trading, SoFi Money for banking, the SoFi credit card, and other products. Here, the company earns fee-based revenue, such as interchange fees every time you swipe the credit card, advisory fees on its automated investing, or payment for order flow. This segment is all about member growth and engagement, and its 12.6 million members are the key asset. The more products one member uses, the stickier they become, and the lower the cost to acquire them. Third is the technology platform, which is the company SoFi acquired, called Galileo. This is the secret weapon. Galileo is the B2B infrastructure, the picks and shovels, that provides the back-end technology for other fintech companies like Chime and Robinhood to operate. Every time a user of a Galileo client checks their balance or makes a transaction, SoFi gets a tiny fee. This is a high-margin, scalable, non-lending business that diversifies the company away from credit risk. The fact that these last two segments now make up the majority of revenue is the core of the bull case. So what is the future outlook? The catalysts are clear. The company continues to add members at a record pace. It is successfully cross-selling new products, as shown by the 1.4 million new products added last quarter. It is innovating, recently rolling out new options trading features and hiring social media finance personality Vivian Tu, your rich BF, to lead financial empowerment initiatives, a clear sign they are aggressively targeting their core demographic. Management was so confident that they raised their full-year 2025 guidance. The expectation from the bulls you see on social media is that this execution will eventually be rewarded and the stock will trade at a valuation reflecting its growth. Comment below how many shares of SoFi you're holding and what your long-term price target is. But the reality is that there are significant risks. The bear case, and the reason for that 8.5% short interest, is not that SoFi is a bad company, but that it is an overvalued stock in a difficult environment. The stock has already had a massive run, and some analysts believe all this future growth is already priced in. There is also the microeconomic risk. If a slowing economy leads to higher loan defaults, it could hurt the lending segment. And if interest rate fluctuations continue, it could dampen demand for new loans, slowing a key part of the business. This is reflected in the official consensus analyst price targets. Even after the strong earnings, the median 2025 price target from Wall Street analysts sits around $25.